Many think global investing is only for the wealthy, but people are quietly building worldwide portfolios starting with just €25 per month.
Even regular European families and mid-level professionals are building global portfolios already. Let me hand this over to Alfie to explain how.
All right, let's talk about something that sounds, well, kind of intimidating: investing internationally. You might think it's just for the super wealthy, right? Well, today we're going to tear that idea apart. We'll show you how anyone can use it as a powerful strategy to build long-term wealth. So let's get right into it.
First things first, just a quick heads up. Everything we're about to cover is purely for educational purposes. It is definitely not financial advice.
So let me start by asking you a question. Is it possible that your portfolio is missing out on like 95% of the world? Sounds crazy, but for a whole lot of people, the answer is a big yes. And it's all because of this really common trap called home bias.
And this chart, wow, it just lays it all out there, doesn't it? So many of us, and we don't even know we're doing it, we cram almost all of our investments into our own country. And look, I get it. It feels safer, but in reality, it creates a massive risk. You're basically betting your entire financial future on the ups and downs of just one single economy.
Okay, so how do we fix this problem? Well, the simplest, most accessible first step for pretty much any investor is to go global using something called an exchange-traded fund, or ETF. Think of them as these little baskets of stocks that you can buy and sell all at once. Seriously, they are your golden ticket to instant global diversification.
But wait, not all ETFs are created equal. And this is a really, really important point, especially if you're an investor in Europe. You've probably heard about US ETFs, right? They're everywhere. But for you, the smarter choice is almost always a European domiciled ETF. They follow these rules called UCITS. Now, why does this matter? Oh, it matters a lot. We're talking huge advantages in tax efficiency, easier access, and, get this, they help you completely avoid a nasty US estate tax trap that we're going to get into in a bit.
And here's the best part, the sheer simplicity of it. You might be thinking, this sounds super complicated, like you need this whole complex setup. Nope. You can kickstart your entire global investing journey with just one single fund.
Just one fund. And what's inside that one fund? Oh, just a piece of over 3,000 of the world's biggest and most important companies. Just let that sink in for a second. With one single click, you become a part owner in a massive slice of the entire global economy.
And this is what that instant diversification actually looks like in practice. A single world ETF automatically spreads your money all over the globe, weighted by market size. So you're getting a piece of everything. You know, the US tech giants, the big European manufacturers, those booming consumer companies in Asia, all of it, bundled up neatly in one single package.
So let's just recap why these ETFs are so darn powerful. The main point is they make global investing something anyone can do. The entry point is super low, you get diversified instantly, they're simple and incredibly cheap to own, and you can buy or sell them anytime the market's open. It's truly the perfect tool for building a global portfolio, no matter your budget.
All right, we've covered stocks. Now let's move on to our next pillar, property. You know, something tangible. Owning a physical asset in another country can be an absolutely fantastic way to diversify, generate some income, and protect yourself against inflation.
And no, you don't have to be a millionaire to get in on this. There are basically three main ways to do it. You can take the easy route with something called REITs. They're kind of like stocks, but for property. Or you could try the modern way, using crowdfunding platforms to buy a fraction of a property. And of course, there's the classic way, just buying a place directly.
Okay, a big warning here. If you decide to go the direct route, you have to do your homework. This isn't something to take lightly. You've got to dig into the local ownership laws, really research the rental market, figure out all the management costs and taxes, both upfront and ongoing, and you better have a clear exit strategy. This isn't a vacation purchase. It's a serious business decision.
Okay, so we've covered the what, now it's time for the how. We're going to get into the pro tips, the crucial details about currencies, distance, and taxes that really separate the savvy global investors from the rookies.
First up, a brilliant little rule of thumb I like to call the flight time logic. The idea is simple. Only invest in physical stuff, like a rental property, in places you can actually get to without a 24-hour travel ordeal. So if you're a Dutch investor, that might mean choosing Spain over, say, Thailand. Why? It's all about risk management. If something goes wrong, and things can go wrong, you want to be able to physically get there to sort it out.
Next up, currency. This is one of the coolest side effects of investing globally.
You naturally diversify your currency exposure. See, if you hold assets in dollars and euros and maybe some yen, a sudden drop in your home currency's value isn't going to completely wreck your portfolio. It acts like a financial shock absorber, protecting your long-term buying power.
Now, everyone who is not a U.S. citizen needs to pay very close attention to this. This is a big one. If you directly own U.S.-based assets, like stocks of American companies, and you pass away, the U.S. government can hit your estate with a massive tax bill on anything over a tiny $60,000 exemption. It's a huge potential trap that catches so many people by surprise.
But there is a simple fix. Remember those European-domiciled UCITS ETFs we talked about earlier? Well, by using them, you completely sidestep this entire problem. Because the fund itself is based in a place like Ireland or Luxembourg, from the IRS's point of view, you don't directly own the U.S. assets. It's a clean, totally legal, and super effective solution.
Okay, so how does all of this actually come together in the real world? Theory is great, but let's make it practical. We're going to walk through a case study, a blueprint for a global investor we'll call Lars.
So here's what Lars did. Step 1. He ditched his home country-only fund and swapped it for a single, global, all-world UCITS ETF. Simple. Step 2. He bought a rental apartment in Spain, a place he could easily get to, and he used a mortgage to do it. Step 3. He even diversified his cash, holding a small emergency fund in US dollars and Swiss francs. He followed that flight time logic, and he made sure all his tax paperwork, like his W-8 bin form, was sorted. See? He built this really robust multi-pillar portfolio, and he didn't need to be a billionaire to do it.
So what can you do starting right now? Here is your actionable checklist. First, go look at your own portfolio. How much home bias do you have? Second, think about making a broad global ETF the core of your holdings. Third, start exploring real estate options. You can start small with REITs, remember? Fourth, think about diversifying your cash savings. And finally, and this is so important, educate yourself on the tax rules that apply to you. These are the real steps to building a truly resilient financial future.
So, I'll leave you with this one final thought. I want you to picture your wealth as a building. Right now, how many pillars is it standing on? Is it all resting on one single pillar, completely tied to one country's economy? Or have you started building a strong, diversified foundation with pillars planted all over the world? The choice is yours to make.